Hello? Hello? Right, welcome. Good evening, good morning, good afternoon, good night to wherever you're from, wherever you're watching. Um, Today we are going to talk about swing trading. This webinar was supposed to start about 10 minutes ago, but I've been having some technical difficulties with the software, the encoding software. So, nevertheless, let's get started. So my name is Alfredo Pardo, and I have been trading for 3 years. I've been, I guess, as most people start trading, they kind of jump around from one strategy to another until they finally find something that suits their personality. And I can now say that I think I have found something that suits my personality. Just one thing that I must say is I've been highly influenced by the works of Linda Bradford Rashke from LBR Group, a hedge fund in Chicago. I recommend you go to her website, lindarashke.net, and under resources you can check out everything she's written. I highly recommend it. She also has a book called Street Smarts. Highly recommend it that you read it. So let's get started. Right. So I first wanted to start off by talking about the different types of traders and strategies they employ. So this is with this slide, it's easy to visualize sort of the types of traders there are in the world, divided up by holding periods. So on the left side we have the high frequency traders, which is all algorithms and super sophisticated computers, which we humans can't compete with, as they trade in nanoseconds. So it's a game we humans shouldn't even try to play. Then we have day traders, which compete with HFTs. Also, they open and close positions within the same day. Then we have swing traders, which do take positions overnight. Maybe average holding period may be anything from 2 days to 10 days or more. And then we have position traders, which may hold positions for months or even years. And then up here, I put the hit rate in terms of the percentage of profitable trades these traders have out of all their trades. For day traders and swing traders, generally it's around from 70 to 80% of their trades are wins. But then for position traders, it falls down to 20%. This is due primarily because the strategy that's employed by position traders is a trend following strategy, and that has many small losses, consecutive losses, but then they make their money back and then some with one huge fat tail event trade. So those are the types of traders. As well, this formula down here, the expected value formula, is, I'm sure all of you have heard of it, is probably the best way to see what trading is all about. Trading is nothing more than probabilities, and expected value is simply the probability of a profit times the expected profit, and plus the probability of a loss times the expected loss. If the expected value is positive, of course, we want to take that trade. And you can backtest these strategies that I will talk about. So trading the swings. What is a swing, and what is it all about? This strategy. So a swing trading in general is 100% technical approach to the markets. Swing traders generally do not look at fundamentals, economic data, or company fundamentals. We are just interested in the pure short-term fluctuations of the market. So what is a swing? A swing is nothing more than a short-term inflection point in price, and we'll talk about why these why these swings occur in markets, why they're produced, and then we'll also talk about the importance of volatility for a swing trader, well, for any trader, but especially for a short-term trader. So let's continue. So here are some statistics I found. Here are some statistics I found on the probability of becoming a profitable trader, and as you can see, they're not too favorable for traders. This is from a study from Barber and other authors titled "Do Day Traders Rationally Learn About Their Ability?" from University of California, Berkeley, and from 2010. And as you can see, 93% of traders quit primarily due to losing money within 5 years of their start. So it's definitely not a good statistic for us traders. But as well, we must ask ourselves, why do markets fluctuate, and why does such a high percentage of traders lose in the markets? And for that, we have to answer this question in front of your screen right now. Why do markets move up and down? Why do they fluctuate? And there is a logical answer to this, and it's simply why do markets fluctuate, and not only that, why are there swings in markets? Why aren't there just one? Why isn't there just one trend up and then one trend down in a very methodical fashion? Well, primarily, swings occur when too many people are on one side of the same trade, and when too many people are on one side of the same trade, then the market swings. One way. Just pardon me for a second. Let me just share the link so other people can view this presentation. So why do markets fluctuate? Why do they produce swings? As I said, I'm sorry, I'm going in circles at the moment. The primary reason is because short-term traders especially get too optimistic too quickly, and when everybody is on one side of the ship, so to speak, the ship turns the other way. And I actually like to compare it to a ship, a sinking ship, where people are on board this ship, and they are trying to guess which way the ship is going to sink first. So the people think, let's say, the front of the ship is gonna sink first, so everybody moves to the back, and as everybody moves to the back, of course, you know what happens, the weight transfers to the back, and the ship starts sinking from the back. Of course, then this creates panic, and you get a movement to the front of the ship, and so on and so forth. And this is very similar to what happens in markets. So we have traders who get too optimistic too quickly, and they push the price up, or they buy at the highs. Actually, I'll talk about that. And then when everybody has bought, of course, and there are no more buyers around, the price moves the other way. So that's why markets fluctuate. That's why we have swings in the market, and that's why I take advantage of swings for their trading. Right, let's continue. So we talked about swings, and now let's talk about momentum, which is very related to swings in the markets. Momentum is simply the rate of change of an asset, how fast, how quickly price changes, and from one period to the next. And we also have to look at momentum's extremes. And on this chart, we can clearly see this is a Euro USD chart, the spot price, and below we have a 10-period. 10-day, there's a daily chart, a 10-period rate of change, and we can see the different swings we have in this market. We can just plot these out, kind of indicate where the swings are, and as you can see, at swing, when there is a momentum extreme, right, when the momentum reaches some extreme figure, some extreme mark, we have a pretty quick reversal to the other side. And of course, the trick is knowing when it is an extreme. But well, as you can see here, momentum extremes equals large number of traders on the same side of the trade. Let me just pause this for a second, and apparently the video is not working. Let me try to fix this. I'll be right back. And apparently the video is not working. Let me try to fix this. I'll be right back. And apparently the video is not working. Let me try to fix this. I'll be right back. And apparently the video is not working. All right, welcome once again. Hopefully the video, the recording is working now. Welcome from wherever you're joining us. Sorry for the delay. Unfortunately, I'm not too good with computers. So all right, so let's get started. So I'm Alfredo Pardo. I've been trading for about 3 years, and today I want to talk about swing trading and what kind of the strategies behind swing trading and all that stuff. So first of all, I want to start off with the types of traders that exist in the world, I guess, and I divided them up by holding period. So we have on the left the traders that hold their positions for a very short period of time, and on the right the traders who hold their positions for longer periods of time. So on the left extreme we have the high frequency traders, which of course use algorithms and high potency computers, high computing power, and of course humans have no chance whatsoever competing against the HFTs. So that's why I put that in parentheses. We don't really care too much for that. Then we have day traders. As you know, they trade intraday. They open and close positions in the same day. And they compete against high-frequency traders. That's why one of the reasons I don't recommend day trading. Although there are some exceptions, of course. There is an exception to every rule. Then we have swing traders, which generally hold their positions anywhere from 2 days to 10 days. And then you have position traders, which hold their positions for months or even years. And Then I put up here the hit rate. So that's referring to the percentage of profitable trades that these types of traders achieve. Generally, for day traders and swing traders, it's around 70 to 80%, and then for position traders, it's around 20%. So these are generally the two types of strategies that you'll find. You'll find the trend following strategies, which is the position traders, which try to bag enormous gains with just a few trades, but they'll have many consecutive losing trades. And then you have on the other side, you have the swing and day traders, where they're going to take small profits and small losses with the occasional larger profit, but most of their trades will be profitable. And then, of course, I put down there the expected value formula. I'm sure most of you know about this, and as trading is all about probability, I thought that this formula really does come in handy. So expected value is the probability of a profit times the expected profit plus the probability of a loss times the expected loss. So if the expected value is positive, of course, we want to take the trade. And there are different ways of backtesting for expected value for our strategy. Right, so trading the swings. What is swing trading? What are swings? Swing trading is 100% technical approach. Swing traders generally do not use fundamentals to predict the swings. It's mostly a technical system or strategy. So what is a swing? A swing is simply a short-term inflection point in price. Why do they occur? We will talk about that in a second. And then we'll also talk about the importance of volatility for short-term traders, especially swing traders. If there is no volatility, we as swing traders cannot make money. So here are some statistics that I found. These statistics are from the Barber and others for the paper titled "Do Day Traders Rationally Learn About Their Ability?" Written in 2010. And as you can see, 93% of traders quit, aka lose all their money within 5 years. So the statistics are definitely not good. But it is important to not just close your eyes and not look at the statistics, because they're terrible if you want to become a trader. We do have to look at them and ask why. Why are the statistics so bad for traders? And there is a reason why they're so bad, which we'll come to next. So the most important question that nobody asks themselves when they start trading, of course, is why do markets fluctuate? Why do markets move? Why do markets have swings in their price series? And I like to compare markets to a sinking boat analogy, or a sinking ship. So let's imagine we have this large ship with many people on it, and of course it's sinking, and the people are trying to find out or figure out which side of the boat is going to sink first, because of course they don't want to sink. And suppose that they're in the middle of a ship and they think that the front of the boat is going to sink first, so of course they race all of them to the back of the boat, and with of course the weight transfer, the back of the boat starts sinking first, which of course causes everybody to rush to the other end of the boat, and then of course the front end starts sinking first. So this is very analogous to what happens in markets and what happens at swings, at swing points. And I like to put this analogy because I think it's very relevant to swing trading. And let's continue here. Momentum. So momentum is very related to what we just talked about of kind of herd mentality of humans. And momentum, let's just start with the basics. Momentum, which I'm sure everybody knows, momentum is simply the rate of change of some asset. So it's just the rate of change from one period to the next. So it measures the speed at which price changes. But it also measures something else. It measures the speed measures the anxiety of the traders, and you must ask yourself, why do traders get anxious and want to quickly buy or quickly sell? Of course, this may not be, you may not be able to back test this, but my theory is that the market swings are created, or market moves are created, not due to profit taken, but due to loss taken. And that's why we have swings, and that's why at momentum extremes, a momentum extreme means that there is maximum panic or maximum euphoria in the markets, and that is precisely the time you want to fade that type of move. So it's very important to keep in mind the sinking ship analogy I spoke about earlier. So this is a chart of Euro USD spot price. It's the daily chart. We have on the bottom a 10-period rate of change, and we can easily see the different swings here. We can just quickly see the swings where momentum reaches extremes and reverses. So around these points, of course, you have to determine the sensitivity of these swings. So if you want a 5% swing, a 3% swing, or a 10% swing, in what you're analyzing. But nevertheless, if we look at the momentum oscillator, we can see that at momentum extremes, there is a sharp reversal in price and momentum. So it's very important to remember that when there's a momentum extreme, people are on one side of the ship, and we want to fade that move. So as I wrote here, momentum extremes equals large number of traders on the same side of the trade. And of course, when everybody is on the same side of the trade, the price quickly reverses and takes the weak hands out of the trade and causes the maximum number of pain to the maximum number of people. That's why the statistics for traders are so terrible, because by definition, the majority of people cannot make money in the markets. The majority of people must lose money because this has to do with expectations and the theory of reflexivity as proposed by George Soros. So if everybody expects something to happen, the price of something to go up, it will not go up, and it will actually go down. So that is why, and of course this process also affects fundamentals, but we won't get into that in this webinar. But yes, you do have to realize that if most of the people expect something to happen, that means that most traders will have positions on. So let's say that most traders expect the euro to go up. So most traders will already be long the euro, which means you have to ask yourself, who else is there to buy the euro? And the answer is nobody. And if there's nobody else to buy, of course, it quickly reverses and takes all of the people that went long precisely at the wrong time, which is traders generally go long at the highs and go short at the lows. That's why the statistics are so terrible for traders. And of course, you want to, about 80% of the time, swing trading, you want to fade the move, and you want to fade the majority of traders. Of course, there are times, about 20% of the time, that we have an extended run, like we can see right here. in the euro dollar, that would be an extended run. And in that case, of course, you would not want to fade the move. You would want to go with the move and go with the what's called an extended run move. And Linda Raschke, from LBR Group, a big hedge fund in Chicago, has done a lot of work on this, and I highly recommend you check out her website, lindarashke.net. Under resources, she has a lot of material on swing trading and momentum and all that. So I highly recommend you check her work out. She has a lot of work. She's also done a lot of backtesting on extended runs. She models the extended runs with the 5-period simple moving average on the daily chart. But nevertheless, most of the time markets are not in extended runs. They are just choppy, like we can see here in the euro dollar these days. So these moves, of course, you want to fade these short-term swings and fade everybody. The majority of people that get too euphoric too quickly, and they panic also too quickly. And of course that causes a lot of pain for most of the traders. Right, so let's continue, because I am sort of going in circles, but I think it is a very important point to emphasize that the majority of people are wrong the majority of the time, or always, I would say, because majority of people cannot be right by definition. If not, markets would just they wouldn't work. So let's continue and talk quickly about volatility and the importance of volatility and the cycles of volatility. So of course I'm not the first the first person to mention this but we do have there have been many authors. Gartley especially has mentioned this. And Wyckoff, Richard Wyckoff as well, has mentioned this. So there are periods of when the market is expanding, and there are periods when the markets are contracting. And Wyckoff put it very nicely, where he said we have periods of accumulation, we have accumulation phases, then we have a mark up or mark down, and then we have a distribution phase. So this is analogous to the expansion contraction phases of the market. The market does change from expanding or trending to contracting or not trending. So we can measure this with many volatility indicators. Probably one of the most popular ones especially in academia, is the standard deviation. So this is the dollar yen, and we can see the 10-period standard deviation. This is a daily chart plotted up here, the standard deviation. Of course, we can see it's a very short-term plot, but we can see that periods of high volatility are then preceded by periods of very low volatility. And even if we take the average of this standard deviation, we can see generally the trend of volatility. So we can see generally from the beginning to around here, we have high period of volatility in this market, and this of course coincides with a strong extended run, a strong trend, and then of course some choppiness in between. And then from around here to around here, where we have the contractionary phase of the market, where volatility is very, very low compared to historical standards. And this is, of course, the period we want to stay away from, because we, as swing traders, cannot or should not try to go with the trend in these low volatility periods, even choppy periods. And then of course then volatility picks up again, and then we have extended runs, and now we have a bit of a choppy phase. And lately, the volatility has contracted in the dollar yen very significantly, and the price is chopping around. Of course, as swing traders, we could employ the strategy of fading the move, but when we do have an extended run, we will get absolutely buried if we don't have proper risk management techniques. So nevertheless, of course, after this period we're currently in the dollar yen of low volatility, there will be a very high volatility. But what happens in this period of very low volatility is that traders get chopped up in this period of low volatility, because you have a new swing high or a new swing low, and then people think it's going to go lower, they short, and then it comes right back up, and they get stopped out, and it goes nowhere. So in these types of periods, we don't want to be too aggressive. We can take some counter trades, fading moves. Fading spikes up and spikes down, but of course the money for any trader is going to come in the periods of very potent extended runs, as we have seen in the dollar yen in 2012, even late 2014. These extended runs right here is where we're going to make our money as traders generally. Right. So let's continue. So this is cocoa, and this is also to exemplify it's also to demonstrate the periods where of expansion and contraction in the market. We have this cocoa, the daily charts. We have volume plotted below, and below that we have Bollinger width. So it's simply the Bollinger Bands, 20 period moving average, and two standard deviations above and 2 below, and then we just take the width of the bands, so that this is what this line is, and we can see pretty clearly here that we have periods of high volatility, and then followed by periods of churning in the market, in price, where price just goes around some central value, and we can see that clearly with the Bollinger width indicator. And then of course we can see, for example, around here where volatility has or is contracting, we can see, if we draw a sideways line through the middle, we can see that price just turns around this middle line until, of course, it finally does break out of the consolidation here. So these low volatility environments do lead to there's a high probability that they lead to very large wins and extended runs. So we definitely want to keep an eye for those, out for those. By the way, the red line on the price chart is a 10 exponential moving average, just so you're aware, and I'll talk about that a bit later as to how I use that moving average. So then, of course, here we have another period of just a sideways line, as Charles Dow put it, where price just goes around some value and doesn't really do anything. And this is the period. These are the periods, of course, we do not want to be in the market. And of course, you could say, well, you could fade the move, and you could buy here. Yes, you could, but you really wouldn't get that big of a win, and the risk reward is really not in your favor. So we do want to play for breakouts in these cases, like breakouts like this one right here, which can lead to big wins. And then, of course, we have some topping formation, and of course we have, it starts to top around here, but then we have one more push up here to take the traders who were short here and put their stop above those swing high. Of course, they're taking out on this spike up. So once everybody is not short, or when everybody is long, as I said, the price quickly turns to the other side, and then we can see another period here where the price goes nowhere. We can draw a sideways line here where the price does nothing, and then we have, of course, the breakout, which we would have played for, and then we have actually the same story as we saw right here. We see it here where the price reaches some resistance, and then there's one day where it takes it out. So anybody who was trying to short there and put their stop above the swing high here was taking out very clearly right here. And of course, once everybody's long, the price quickly turns to the downside. So this is kind of what I like to look at, kind of extremes in sentiment, in momentum, kind of see when everybody is on one side of the ship. So let's continue. And then, of course, we have this coffee, the daily chart. We have periods where as a swing trader, you have really no chance of making any good money. You just get chopped up like this. So we can see that from around April to around August in coffee, we've had a period of very low volatility where we have had swings in the market, but the length of the swings have been absolutely dismal in terms of the length of the swings. So the contractionary phases of the market can last very, very long, longer than you expect, of course. And if you were in this market, you would have gotten definitely burnt out, just trying to see if this was going to lead to an extended run, which if you were in this period, it wouldn't have, and it still hasn't really. So once we see this choppy type of price behavior, we do not want to take part in any trade. In any trade for more than, I mean, you can take a quick scalp if you so wish, and you can fade some swing, but I don't really think it's worth your time, and I think you should really pay attention to the potential extended runs. So let's continue. So this is what I was talking about in terms of noise or choppiness. So this is cotton, a daily chart, and you can see it's very, very noisy. And when I talk about noisiness or choppiness in a market, it simply refers to randomness in the price series or in the time series. So you can see you would have just gotten chopped up very, very nicely here. And you do not, as a swing trader, want to participate in these types of markets because the probability that you get chopped up is very high. The probability that your stop loss gets hit is extremely high. So for these types of markets, if you want to trade them, you would have to use an extraordinarily large stop loss, which in swing trading really is not. It's not the point of swing trading. So be aware of these types of markets and stay away from them if you are looking to swing trade them. So let's continue with relative strength with market structure. So the concept of market structure is analyzing the swings, so the swing highs and the swing lows in price series, and relative strength is simply just comparing those that market structure, those swing highs and swing lows, with other markets, correlated markets. So this is from Arthur Merrill from his book Filtered Waves, and it's simply the structure of the market in terms of waves. So he used to use, I think, a 5%. So a 5% move up or 5% move down to define a swing. And what this does, it eliminates most of the noise you have between the swing highs and the swing lows, which as a trader you really don't care about. As a swing trader, you don't care about. So it's very good work from him. So relative strength is simply taking two correlated markets like silver and gold, silver on the top, gold on the bottom, and just comparing them in terms of their swings to see if which one is stronger or which one is weaker. And of course, you want to always buy the strong market and short the weak market. So that's the primary principle of swing trading, or of momentum as well. So we can see that around this period, using swings would have been, in gold, would have been quite useless because it's very choppy, and when the market gets choppy, using swings it's very pointless. Silver has also been quite choppy lately, as you can see. So it's very difficult to compare the swing highs and swing lows at the moment. But we can see, one of the things we can see is actually, if I'm not mistaken, silver did break out of this above this swing high before gold did, right here, right? So that does indicate to us that silver was the relative performer a few days ago. So that's one of the things to keep in mind. Let's continue. So this is the New Zealand dollar against the Australian dollar. The same principle applies, really, although the New Zealand dollar has had a period of very low volatility, consolidation, while the Aussie has been swinging, although in a range nevertheless. But we do see that the New Zealand dollar had broken out above the top of the range before the Aussie broke out. The New Zealand is the relative strength outperformer once compared to the Aussie dollar. So let's see if we can continue here. Right. So yeah. Okay, so same thing really with crude oil, with WTI, and with compared to Brent. As you can see, we've had actually an extended run in both types of oil. An extended run. You can, how I define it is multiple closes above or below the 10-period exponential moving average, around 10 closes above or below the 10-period exponential moving average. So if we have a minimum of 10, to me that is an extended run. Linda Raschke defines it, uses the 5 simple period moving average. She's done a lot of work backtesting that, but in my testing, the 10-period exponential moving average does work better. So as you can see, oil just back in this summer was just turning around a one value, and you really didn't have any opportunity to swing trade it. And then of course it did break down of the range, in which case you would have a new momentum low there, and you would want to fade any move up, which we did have in both oils. And then of course this led to an even bigger win. So and then of course we've been just chopping around around here, not really doing much, and then we had one spike up, which tricked a lot of people, because of course that's just what the market does. People thought that oil was going to fly, and of course it came right back down to the range. So that's what I have to say about oil. By the way, yeah. So I just saw the question by Gary Official TV. Open interest. So he's asking if I could explain what open interest is. Open interest. Let me just put this up. All right. So open interest is the line. Let me put a full screen chart. Like this one. So there's the British pound, the daily. So open interest, as you can see, is this purple line we see on the bottom of the chart, where volume is. So open interest is nothing more than the contracts that remain open in some market. Of course, this is the futures market. That's why we have volume and open interest for the British pound. In the forex market, of course, we don't. But yeah, that's open interest. So it's just the contracts that remain open in some futures market at a certain period of time. Larry, if you read the book, titled Technical Analysis by Kirkpatrick, Charles D. Kirkpatrick, he explains how Larry Williams, a famous commodity trader, used to actually say that open interest represented the commercial hedgers in the market, because of course commercial hedgers are always short some commodity because they short a commodity against inventory. So when open interest falls, that means that commercial hedgers are out of the market, and it is usually a sign that the price will turn. And that applies to both sides. So if we have an open interest extreme to the upside, because a lot of people, a lot of commercial hedgers are taking short positions, then when it's at an extreme, it usually the price turns around, and then same thing to the downside. When open interest falls to a new low, that means commercial hedgers are out of the market and aren't short anymore, and that is a pretty accurate sign that the market is going to turn to the upside. So it is a according to Larry Williams, it's a good indicator. So it's hopefully that answers more or less your question. So to compare open interest to volume, volume is just the number of contracts traded in a day, but open interest is the number of contracts that are still open, right? That traders, in this case, well, traders generally haven't closed. And of course commercial hedgers specifically, because those are the guys that are always short the market. So hopefully that answers your question, Gary. So let's continue with the British pound. So this is the futures market, this is the futures price, not the spot price, just so you're aware. And as you can see, right here between these two lines that I just drew in, we can see extreme choppiness in the data, where if you were trading this on a swing trading type of strategy, you would have absolutely gotten chopped up, and you would have given up pretty quickly. And of course, as the market always does, so we can draw a sideways line there, we can draw a resistance there, and a support around there. And of course, as the market always does, it tricks 99% of the people all the time. The market seemed like it was breaking out around here, and of course it quickly reversed. There was a quick price rejection, and everybody who went long around here of course got stopped out very quickly and very violently on the way down, which pushed the price down pretty quickly. And of course, as I said, when people get too negative, too bearish too quickly, as happens right there, we have a swing low, and it quickly reverses, and whoever shorted on the lows, on the way down, quickly gets stopped out when we have a price spike. And of course the same thing up here, everybody goes long at the highs, and of course it turns around because there are no more buyers left, so the weak hands are taken out very, very quickly. Also want to talk about, as you can see, it's been, the pound has been swinging quite a lot. I mean, these swings are very significant, especially for a currency, but no definitive trend is in place, and as swing traders, we do want to go with the trend, especially the extended trends, when it's a very sharp, unexpected move. That's how extended runs are created. So no real trend. So at the moment in the British pound, so of course a swing trader would be fading the swing highs and swing lows. But we do see around here, we can see sort of a sideways line as well, some contraction in the market and in volatility, and we can also use a breakout strategy to go long here. But of course it wouldn't have, well, it would have definitely scared us when it spiked down on this day, and maybe even got us stopped out. And of course the next day it shot back up. So it is quite a choppy trading environment at the moment across the board in the major commodities and currencies. Let's continue with palladium. Palladium, we have, as you can see, sort of a rounding bottom around here, and of course that's a bullish pattern. And lately we've had, in the past 2 weeks or so, some sort of consolidation as well. We can draw a sideways line, and volatility has reduced. So of course, as I said, we want to use buy stop orders to play a break above or play a break below this setup. I must admit, I did get a bit aggressive today with this trade. Instead of just waiting for the breakout, I decided I would outsmart the market, and I decided to short right here, because it was a low risk short at this level. We've had a push down, and then a slight push up, and then it seemed like momentum to the upside was slowing, so I decided to short and put my stop loss around there. But I waited for the US Open today, and when it opened, the US stock market, which is when we have more volume in the assets, we didn't have a price break. So I decided to quickly close that position. It was a very quick trade, aggressive trade as well, which I gave up on pretty quickly. This is the T-bond market. Just a quick comment about this. It's a very choppy market. It's very difficult to trade this from a swing trading perspective, because you're not going to get those extended runs, those big profits that you try to aim for. Right. So this is platinum. Same idea. We have a downtrend, and then we have sort of a sideways consolidation, and then we have a break lower, and then of course people get too bearish too quickly, and we have a push up. So that's platinum, and then when we look at silver, we'll also see the same thing. Let me just do that. Right. So let's continue. So actually, this is the Japanese yen, and the Japanese yen, it's the futures as well. As you can see, extreme choppiness in the. Let me exit this. Okay, extreme choppiness in the data. If you were trading this, you would have absolutely gotten chopped up. If you didn't realize that the yen was just in a sideways type of consolidation, where you shouldn't trade it at all. But yeah, so that's very important to realize. So let's continue. I have a few more markets. I may skip a few. Wheat also very volatile. No definitive trend. Not easy to trade when it's very choppy and noisy. Corn, say more of the same thing. This is actually interesting. The the dollar index. So let's. You can see very choppy as well. Let me just. Very choppy in a contractionary phase, and you could fade the moves, fade the trade inside of the range, but I think for me at least, it's just too much work for too little profit. So that's my opinion on the dollar. It just hasn't gone anywhere. So we'll keep an eye on this, and this of course will determine where the commodities go, and will determine just about everything. The 10-year, just about the same thing, very choppy. This is natural gas. Natural gas has had a very choppy period up here, but then has sort of had a trend down here, but also very choppy, and we do see sideways lines, and we do see just choppy behavior, not very attractive. And then this is the euro. As I said, this is very choppy as well. As I said, most markets nowadays are actually very choppy, and trading has been somewhat of a struggle lately. Even Goldman Sachs is struggling. If you look at their if you read their report, they are struggling. But nevertheless, it is a choppy environment. So you think it's going to break to the upside, and then it breaks to the downside, but then it reverses, and it's just it's very difficult to trade in this environment. So I think I have a few more charts left. Yeah, just 5 charts or so. Canadian dollars, just more of the same. Very choppy around here, and very choppy. And then of course it tricks just about everybody here, because we think that the Canadian dollar is going to make new lows because it seems like it's breaking out here. But of course, it never does what the majority of people expect. So it takes everybody who was long around here, it takes them out here, and of course, when everybody is out of the market, that is exactly the point at which it reverses. Now we are seeing a higher degree of trendiness in the Canadian dollar. So this would count for me as an extended run. We've had several closes above the 10 exponential moving average, so that's that will most likely continue, but of course we must watch it closely. The Swiss franc, very, very choppy, just like every other market really nowadays. We can see very choppy. Oh, that's quite a big line there. So very choppy market, just not very attractive in terms of trading. Then of course we've had a breakout of that choppiness, and it does seem like we are starting to get some degree of trendiness in this market. And then we come to the U.S. Indices, stock indices. This is the Dow, the Dow Jones. We've had a massive fall here in late August, and then we've had somewhat of a triangle. I guess you could classify this as a triangle. I guess you could call this an ascending triangle here, and then. No, that's fine. And then of course everybody thinks it's going to break to the upside, as we can see with this spike up. So everybody goes long, and of course it doesn't. So it comes right back down, gets everybody stopped out, and once everybody is out of the market or is short, it spikes right back up. So we are seeing again more trendiness now here in the market. Whoops, that's not supposed to happen. We are starting to see more trendiness here, but we're still not out of the woods yet. And same with the S&P. And then this is soybeans. I put this example because I am actually currently long soybeans, simply because we've had a consolidation, a range in the past few weeks, months even, and since around September. And we can see that it has spiked up, and we've had 3 days down, including today, and I am currently long this, so we will see. Another thing, actually, as Gary asked before about open interest, and I explained about the commercial hedgers, we can see open interest has dropped significantly lately. Let me just put some sort of arrow here. We can see open interest has dropped significantly in the past few weeks. So what does this imply? At least according to Larry Williams, is that the commercial hedgers are starting to lift their shorts, so they are no longer as short as they were. So this is creating some demand for soybeans. So I do expect soybeans to continue to rally. And we are seeing, of course, volume entering the market as well, which is important. And finally, we have copper. Copper, really just like most other markets, also very. We've had a degree. We've had a bit of a trend here around from late May to late August, and then of course it broke back up. But at the moment we can draw a sideways line, and we can see that the price is going nowhere. It's just moving a bit up and a bit down, and if you are trading this expecting some large extended run, you of course would get chopped up and lose money. So that is copper, just very choppy. Even if you look at the intraday, you can see that the wicks of the candlesticks or bar charts of the chart are very high, and that implies that there is a high degree of choppiness, high degree of noise, high degree of randomness. So you don't really want to be in this market unless you use a very wide stop loss, which I don't recommend for swing trading. You really can't or shouldn't trade this. And that is essentially it from me. I hope you enjoyed. If you have any questions, please, now is definitely the time. I know there is some delay in the feed, so if you have any questions, please post them on the YouTube channel chat thing. So I'll wait a few minutes just in case if there are any questions. If there aren't any questions, thanks for listening, and hopefully you've learned something new, and hopefully you've enjoyed it. And yeah, I'll definitely do more webinars in the future on different trading topics. So it seems like there are no questions. So thank you for listening once again, and I will see you the next time I do this web chat. Thank you very much. Bye bye.